On the floor, Clark Yingst, and then Dan. I always forget your first name, Dan. Dan Frishberg. We're going to get to the Treasury bubble, but I want to start with GE itself. There's one of two things is going on here, because the dividend yield's up to 9%, the stock is getting knocked around, and the CEO's coming out saying, listen, we believe our AAA is intact, we believe our dividend is intact. Either it's not intact, which is why it's got a 9% yield and the stock's behaving the way that it is, or the stock is very cheap. I mean, you can't have what the CEO is saying be true and have these prices and these yields sustain themselves.
Well, the stock can be very cheap, but it may not have any real growth in profits coming anytime soon, and so the speculators don't really have any reason to speculate on them. And that's what the problem is. The balance sheet stuff that you're talking about probably isn't the problem. They're probably wrong about the balance sheet.
Meaning the market's probably overdoing about the balance sheet.
Yeah, but the people who would come in and take advantage of it don't want to do it because they're not going to have any earnings growth.
If you win the battle, you still get nothing.
That's right, exactly.
Your thoughts on GE?
I was surprised. I thought mistakenly that given the news and given the very strong statements made by management, and given the way the stock had been acting earlier this week, that in all likelihood we'd have a stable of higher GE today.
Sure. We
don't, I think, because the market just does not believe that the dividend is secure, or believes that they're caught between a rock and a hard place. Either they cut that dividend substantially, or they sacrifice the AAA credit rating, or both. I'd also note that...
Do you agree with that? In other words, and not that anybody can know because the future is such an uncertain thing, but that's the thing. It's either the AAA rating stays and the dividend gets cut to do it, or they lose the AAA rating and then the cost of capital goes up and it's a whole,
the precedents without the financial sector, and we're talking about GE Capital Finance, would suggest that the market has that correct. I would also note that earlier today, the bank sector in general is doing very well, but not GE. That, I thought, was a troubling divergence.
Yeah. All right. One last thought on GE.
Yeah. I was going to say they've always been the poster child for commercial paper,
right?
And they've been so
for those playing along, that's basically short-term borrowing.
That's right. We didn't even think of that as leverage in the old environment.
Right, because you assumed that market would always be there.
That's right. But now there's a question. You could imagine a situation where they couldn't continue, even though
or anybody. I mean, not just them. I mean, go down a list.
Well,
you're functioning on 90-day loans or whatever it is, and the 90-day loan market goes away.
Sure.
Welcome to the fall of 2008.
But you're used to not thinking of companies of that stature being dependent on credit.
On 90 days worth of paper.
That's for trailer trash.
Right.
You see, that's not for
and
GE.
we all learn differently. Very quickly, then I'm going to move on.
Well, that's true, but based on the statements they made today and taking those at face value, they claim that the commercial paper market has actually strengthened since last quarter. And,
I'm sure it has.
And that they have not accessed,
the Federal Reserve is buying commercial paper.
I understand that, but they have not accessed that facility.
Right. But the point is the Federal Reserve sponsorship of the commercial paper market, I would argue, is one of the most important things that happened in the past 4 months to create stability in the whole
but you understand, when they drop the short-term interest rate, they kill the money market funds, who are really the real source of money for the commercial paper market.
They're the ones that actually extend those short-term loans.
That's right. Now, they can't make any money. The only ones who can supply the commercial paper market
is us.
But we don't like to do that. You know, I like to do it privately, not as a group.
As an institution, as a group of 300
million. And the Fed, I believe, is also willing to buy commercial paper from those money market funds.
Right.
So another innovation in the commercial paper.
Yeah. No, listen. There's a lot of things to criticize. That's one I think worth a lot of praise. What they did with commercial paper clearly was effective and important.
In this state of mind, but in this state of mind, you'd rather, if you're going to invest in something, I want to invest in people who don't have to raise money.
Of course. I mean, look around. I mean, I got tickers on every screen behind me. Anybody stand out at you?
No.
Exactly. That's the problem. Does anything stand out to you, Clark? So everybody's risk averse. The other bubble, the current bubble, if it is a bubble, and we don't know, is treasuries. The implication of a bubble is an irrationally priced asset, whether it was a tech bubble, the housing bubble, and that when an irrationally priced asset dissolves, everything goes to hell. We've lived through it. You argue that if there's a treasury bubble, which has everybody hiding all their money away from every place else, and we're able to actually prick it and dissolve it in an orderly fashion, unlike other bubbles, this would actually be an economic positive to see the treasury bubble dissolve and money flow back into corporate credit and all the rest of it.
Yes, if it's driven by, if it's a bubble. It's a bubble, in my view, not driven by greed or irrational exuberance.
But fear.
It's a bubble driven by fear.
Sure.
And if that's irrational, then that implies that fixed income investors are significantly overpricing all other credits.
Right.
So provided that the bubble deflates in a slow, orderly way,
the cost of capital for everybody else,
that money's going to be deployed in other credits, which would help to revive the economy.
Dan?
Yeah, see, treasuries get their price from the inflation rate.
Right.
And the inflation rate, they have a bigger spread than they used to. The inflation rate and the short-term interest rates. They have a bigger spread than normal. They're not excessively expensive, and the interest rate is
treasuries are not relative to inflation.
Relative to the things that they're priced against.
Right. Understood.
That's to say, it's not a bubble in your view.
It's not a bubble.
Right.
That's right. It's rational.
Right. All right. We can do this all year long. That's the fun part.